Hey, in this video, I'm going to answer the question, what is a pro forma cap rate? So if you're in real estate, you are very familiar with a cap rate, which is the net operating income of a property divided by the purchase price to be represented as a percentage. And it roughly represents kind of the estimated return that you might expect on the property. And so you have a cap rate when you purchase a property. You're purchasing it at a certain cap rate, but you can also be asked by maybe investors or lenders for a pro forma cap rate. And pro forma typically means, a forecasted cap rate. And so I'm going to walk through what that means exactly and how to calculate that and kind of the differences between just a typical cap rate and a pro forma cap rate. Before I dive into that, just a little bit of background. My name is Adam Huxema. I'm the co-founder of ProjectionHub. We help entrepreneurs create financial projections for investors and lenders. We do a lot of work in real estate development and real estate acquisition, and so helping folks create financial models for real estate projects. And this is a common question that folks get about cap rates and pro forma cap rates, and so wanted to just create a quick video to help provide some clarity here. So with that, I'm going to go ahead and dive into this template here and kind of use the template as a way to demonstrate what this means. Okay, so we're going to start with just a simple Google definition here. The formula for a cap rate, and I already mentioned this, but the formula for a cap rate is the annual net operating income divided by the market value of the property, or the purchase price, the price you are paying or planning to pay for a property. So, for example, a property worth $10 million generating $500,000 of NOI would have a cap rate of 5%. So you'll often see cap rates represented as a percentage. You might hear people say kind of short form like a 5 cap. They mean a 5% cap rate. And so I put down here kind of 3 different scenarios. So you could have a purchase price here like we've outlined, the 10 million, 500,000 NOI. And then when you take the 500,000 divided by the purchase price, you get the 5% cap rate. Now, if you're asked for a pro forma cap rate, that means they want you to include the cost of renovation in the pro forma cap rate. And so in that scenario, let's say you're going to buy the property for 10 million, but you're going to put in $1 million worth of renovations as well. So now you're up to 11 million purchase price plus renovation. And if we're assuming that the NOI is just going to stay the same, if that's what the investor lender's looking for you to provide too, that we're just using the current net operating income, then your pro forma cap rate is actually going to go down. So your expected return basically is going down because your cost here is going up without increase in the net operating income. So that is, I guess by definition, pro forma cap rate. Now you might also be wondering though, what if I had a pro forma net operating income? What if I had forecasted net operating income because I'm going to make these renovations and then I'm going to increase the rents and I'm going to increase my net operating income. And so we can look at an example there. We said, okay, we're going to spend an extra $1 million on the purchase price, so we're at 11 million, but we're also going to be able to increase our net operating income from 500,000 to 600,000. So in that situation, our pro forma cap rate is actually 5.45%. So it's actually a better return than kind of that original cap rate here that we calculated. So in order though to even be able to kind of forecast a net operating income, you really need to create a financial model, a set of financial projections, also known as a pro forma, to be able to create a forecasted net operating income for the property. And so that's why I've got pulled up this template here as an example, just to show you what that process would look like and how you'd actually be able to calculate this and what somebody asking for a pro forma cap rate, what they're really expecting you to do kind of behind the scenes there. I have pulled up here our multifamily apartment acquisition renovation template. This template allows you to build out assumptions to create a set of projections, a 10-year projection or pro forma for an apartment complex that you're looking to acquire, renovate, and then operate. And so this is kind of the at a glance tab. At the end of the process, once you've created your projections, you'll see you have this net operating income here, your NOI, this forecasted NOI for the 10 years. So even within the idea of, if we go back to this, what NOI are we using to calculate the cap rate? That's a great question, because do we want to look at the first year's NOI? Well, 10 years out, we expect our net operating income to increase. What NOI do we actually use? It seems like a simple question, but there's actually a lot here that you could do. I'll just show you what else is kind of in this model. So you also get a 10-year income statement pro forma, 10-year balance sheet, and a 10-year cash flow statement. You also get some comparisons here. So once you fill everything out, you'll be able to kind of compare. Here's the pre and post acquisition comparison. So we can see that we had this cash from operating activities of $924,000 prior to our acquisition, renovation, improving the net operating income. But post stabilization, after we've acquired and renovated and stabilized the property, we're up to 1.1 million here in this example. This perhaps might be the the NOI you're using in a standard cap rate. That's the current NOI basically. And this could be your pro forma NOI once the property's stabilized. We also have the cash flow statement, balance sheet, and income statement all broken down by month for each of the 10 years actually. So you have that monthly level detail as well. Just to give you an idea of the type and kind of the amount of assumptions and work that really need to go into this to do this properly, I'm just going to run through these input tabs just so you have an idea. But we have a different unit type. So we have got studio apartments, 1 bedrooms, 2 bedrooms. We need the number of units, the number of square foot in each unit, the rate per square foot that we'd be charging. And this is the starting rent. So this is helping you get the kind of historical financials. And then here's after renovations, here's what we forecast our rent to be later. And then we have the ability to say, okay, we're going to start changing rent rates on month 1 once we buy the property. But it's going to take us 12 months to kind of cycle through all the leases to actually get them up to the new rate. We also have the need to put in operating expenses. So you need to, add your different operating expenses as a per unit, per square foot, or entire property basis. If you have any salaried positions, you want to enter in those salaried positions. You're going to have to enter in details around financing. So how much debt are you taking out? How much investor money? What are the rates and terms on those deals? And then what is the purchase price and the renovation budget here? So there's details around that. Ultimately, all that detail is important and useful in calculating the net operating income. So if you're really looking for what is that future pro forma NOI, so you can actually calculate a pro forma cap rate, this is the kind of process you're probably going to need to go through. So we have a number of different real estate templates that we'll put a link to down in the description of the video below. So you can go grab one of those to calculate your projections and ultimately provide that pro forma cap rate. So hope this has been helpful. If you have any questions along the way, please reach out at support@projectionhub.com or leave us a comment in the comment section of the video below. All right, thanks.